and thank you for inviting me into this session. It's such a great opportunity. I don't take it for granted. And okay, like she already said, my name is Adenike Ogunyale. I'm the head of retail and mass affluent at Cordros Asset Management Limited. Before I start, I would like to commend Shay on this charitable cause. Shay, this thing you're doing, as small as it may seem, it's huge because this is you bringing young people, young professionals together and sensitizing them, enlightening them on financial literacy. This is huge because it's a step into the right cause for the future. So if you don't get your finances right today, your future is going to be in trouble. So the earlier, the better. So thank you so much, Shay, for this initiative. I hope that you get the reward that you deserve. Or not all heroes wear capes. So Shay, you're a hero. Thank you so much. So today I'll be taking us on investing with the right attitude. Before I kick off this session, I'd like to ask a question, rhetorical question, just something to, keep your mind busy for the rest of the next few weeks, few months, few years. What kind of retiree would you like to be? Would you like to be the kind of retiree who um who waits for food to be brought to them at their table, or who already have food on their table? Do you want to be the type of retiree who you want to eat lunch at Monaco today? You can decide to go to Monaco at 65. You want to relax your head in Bora Bora, you can just go there for a few days and come back home. You want to take a vacation to see your grandchildren. You don't need your children to send you any funds to do that. You can just do that. Or do you want to be that oldie? Do you want to be that retiree who, if their children don't send them their monthly stipend, they will literally starve? And then you find out that those are the kind of parents that will now start with their kids into meetings just because they did not send what they were expecting. What kind of retiree do you want to be? You can make that decision after this presentation. Wealthy people plan for 3 generations. Poor people plan for Saturday nights. It's simple. If you fail to plan, you plan to fail. I mean, we heard this a lot growing up, so there's no need to explain it. You already know what it means. Now, out of 100 people at retirement, 1 will be wealthy, 4 will be financially secure, 5 will still be working because they have to, not necessarily because they want to, but because if they don't work, they cannot eat. 36 will be, of course, dead, and 54 will be broke, dependent on family and charity. Now, if you were listening to me in the from the first things that I said, I spoke about you waiting on your family or your children to send you money before you can feed. And then I recall sometime during the week, I was having a conversation with Sheyi, and then we talked about how some parents are actually really, like, literally waiting on their kids, to provide for them on their meager salary. Like, a lot of people earn 200K and below, but the parents expect them to, cater to their needs. They don't even care how much you earn, but they're just like, oh, we need to do this. You have to do this for the family, or you have to send your sister to school, or you have to send your last born, through college or something like that, despite, how little you're earning, putting pressure on your own income. That is the mistake that our own parents made. This is the statistics from the time of our own parents. This is their generation. Now, what are we going to make of our own generation? Think about that, and then you decide that at the end of this presentation. Now, 4 things I would like you to consider when you are looking towards financial freedom. Your income, expenses, assets, liabilities. You need to know what these things are. growing up a lot, we heard people say random and you always need to buy, you want to pay rent, you want to shop, you want to buy food, you want to travel, you go on a vacation. Those are expenses. Your income is basically what you earn every month, every year, whatever period. But what comes to you, what you work for and comes to you as, spendable. And then if you minus your expenses from your income, you have your disposable income. And out of that disposable income, you can get your assets. You have a property, you have your investments, you have your shares, stocks and shares. Liabilities, of course, your owings. What do you owe people? So how do you determine your wealth? So you can measure your wealth in terms of time. Your available money today divided by your monthly expenses times the number of months. But let's move on. There are several misconceptions about financial planning, but I'll just take us through a few. Financial planning is for the rich. I hear this a lot. When we go and do presentations to people, and they are hearing investment. I think the word investment can be very scary to people. They are thinking, oh, we are talking, 1 million. If you have 10 million, if you have 20 million, that's what they think investment is about. In actual fact, it is when you are poor that you need to consider investing, because investing, if you understand the idea of compounding interest, you can literally be rich from compounding interest. So if you were poor and then you take your compound interest seriously, you can be rich. Investing is the same as financial planning. It's not the same. It sounds like the same, but it's not. I am too young to think about financial planning. Well, I was in those shoes too. I seriously thought about this when I was young. I'm like, why is everybody saying invest, save money? I mean, I have parents. Why do I need to save? Tax planning is financial planning. No, it's not. Insurance planning is financial planning. It is in a way, but it's not exactly it. Anyway, let's move on. What is the financial planning process? Before you consider having a financial plan, you need to, first of all, have important information. If you do not have information, you would not know where to start, you will not know where to go, you will not know how to go. So this is an example of information. So you are here today listening to my voice is because you want information. You are looking to have a financial goal. You have a financial goal and you're looking to have a plan. So what do? You attend webinars like this. You attend sessions like this to listen to what they have to say. And once you gather all the important information, you can go to the next step. Establish goals and objectives. So now you know what the information. You have the information. You know what's available in the market. So what do? You set a goal. In the next 10 years, I want to be able to save 10 million doing so amount every month, right? And your objective is now, okay, now that I have a goal, how do I achieve this? So if I want to do 10 million in 10 years, I need to save so amount every month to achieve that. Then you evaluate your current situation. You look at your books. What's my income? What are my expenses? What assets do I have? What liabilities do I have? Based off of that, you can then have a proper plan. Then after you have evaluated that, you can then develop a comprehensive plan. So now that I know how much I earn, I know how much my expenses are, I can decide how much should be going into my investment every month. Implement a plan. That plan has to be a plan that works. Do not have an impossible plan. Do not have a plan that would be strenuous on your day-to-day life. I mean, maybe you earn 500K a month and you're telling yourself, oh, because I started late, let me be doing 300K a month. Meanwhile, you have rent to pay. So you have to be realistic with your plan, right? Then you have a plan. You're already going with your plan, right? You have done 3 months. After 3 months, do a review. How have I done so far? Have I been able to meet up? Have I been straining to go back to your plan, rework it, and then keep going? So what's financial planning? Managing your financial resources for a comfortable future. Comfortable future. I keep using future a lot because I'm not saying save towards your rent, by all means, save towards your rent. In fact, if you don't save towards your rent, that's your headache because you probably will not have a place to stay in the next year or in the next few months. So that one is a no-brainer. Definitely save towards your rent. I'm talking future. I'm talking 10 years from now. I'm talking 15 years from now. I'm talking 20 years from now. You need to start putting monies aside to cater to that future. I have a lot of clients who are as young as me, maybe younger than me, having meetings with me and telling me they want to start planning for retirement. Initially, I would be like, are you sure you don't want to? And then later, it occurred to me that really, in actual fact, we should be planning for retirement today. I'm not saying retirement because I'm trying not to scare anyone so you don't feel like, you're getting old and all of that. Future is equal to retirement. Your future is equal to your retirement. Because when you retire, you have no income. When I say no income, like you do not have like a job, you don't have that energy to wake up in the morning. In fact, you're already at that age where you should just sit back and relax and just enjoy the fruits of your labor. Do you understand? So do a comprehensive evaluation of current and future financial state using currently known variables to predict future cash flows. That will equal to your financial plan, right? And for your financial plan to work, it has to be systematic, it has to be consistent and cumulative. Benefits of financial planning. It's going to improve your cash flow, right? Okay, I was going to say income and expenses. We already talked about that, right? But you also need to look at your economic condition. Look at inflation today is at 27%, all-time high, which means that the things that you could comfortably afford in 2021, the things that you could comfortably afford in 2022, you can no longer comfortably afford them in 2023. So now that's where your reevaluation comes in. Go back and check, okay, now that inflation is at 27%, I'm buying these things for more expensive. Do I still need this thing? You need to ask yourself that question and be realistic. Do I still need this? Is it still essential to my day-to-day living? Is it important? If it's not, yank it off. If it's a luxurious item and you feel like, oh, you still want to enjoy your life and everything, oh, my sister, my brother, enjoy your life by all means. However, go back into your other expenses and remove some other things that you think are not necessary and not essential. Otherwise, because as it is, inflation is already thinning out your disposable income, right? Which means that, of course, which means that you can invest less. Your regular expenses, food is more expensive. Your income has not increased. So you've been earning 500K since 2021. It is 2023. You still earn that 500K. But if you used to spend 200K on food in 2021, now you're spending 300K on food. Can you see that you have less disposable income? So what do? You cut down. If you used to eat prawns, go and be buying shrimps. Do you understand? If you used to eat lobster, go and start buying prawns. That kind of thing. Just make that shift. Evaluate your true position. Compare it to your economic reality, right? Next is okay, so yeah, one of the benefits is it's going to make your retirement years comfortable and secure. I've been saying this from the beginning of this presentation. Your future is your retirement. If you start investing today, you are investing towards a comfortable retirement. It's going to increase your savings and optimize the growth of your wealth. And then you are able to transfer your assets and your estate to your heirs in the most effective way. That's, of course, your children. Budgeting. Budgeting is a very important aspect of financial planning. You need to understand the basics of budgeting, right? It's a plan for your future. It includes income and expenditure, which you can use as a guideline for savings and spending. It's a key component of financial success. Without budgeting, you hardly not be able to achieve financial success. It can help you allocate funds appropriately, of course, and then you can develop a great financial discipline. With budgeting, you can discipline yourself. If you earn 500K a month, you tell yourself, on enjoyment this month, I'm not doing more than 100K. Stay with 100K. On food this month, I'm not going to do more than 200K. Stay with 200K. Like that. That's how to budget. So let me give you a budgeting scenario. I mean, this of course is a no-brainer to everyone. So I'll just breeze through it. This person earns 100K, right? Expenses is 100K. Look at that. This other person earns 100K. Expenses is 80K. So they are able to save 20,000 for investment. If you save 20,000 for investment every month religiously, I will show you what that will come to in the next few slides. So let's talk extensively about investing. Put your money to work for you. We're not talking gambling here. We're not talking, oh yeah, there's this MMM scheme. If you put 50K, you get 100K in 3 months. That's not the kind of investment I'm talking about. That is actually literally throwing money out of the window. If you do not know what you're doing, you are going to be throwing money out of the window. So I'm not talking about gambling. I'm talking about investing correctly, investing with the right attitude. So what is the major reason for investing in the first place? Financial security, nothing else. Now, something I'm going to mention today is how time is very crucial to your investment. It's not even necessarily about how much you invest. It's really about how much time you have put into investing. And let's do this simple example. So you have a lump sum investment of 5 million, right? So you have 5 million right now. So you put 5 million in an investment. And then you tell yourself, now that I have 5 million in my investment, every month I'll be doing 100K into that investment. And I'll put it in an investment that will be yielding 10% in return per annum, right? So we'll do a scenario of 25 years, 35 years, 45 years, 15 years, 25 years, 35 years. Now in 15 years, after you've done this religiously, and you have not taken the interest, which means that you have put back the interest into the investment and it has generated more interest for you. That's compounding interest, right? In 15 years, at 10% return, you will have 64 million, right? In 25 years, at 10% return, you will have 194 million. In 35 years, at 10% per annum, you would have 594 million. Now, you need to bear in mind that it's not your money that is 594 million. It is actually the interest. So you did not drop 594 million in this investment. You have done this investment religiously, plus your principal and your interest has amounted to 594 million. And the reason why you have this much is because you gave it time. Time is the most important, I would say. I like to say most important because we truly underestimate the value of time when it comes to investments. Time is of the essence. So I would like to open our eyes to a few investment terminologies. I don't know if we've ever heard of this before, but if we haven't, this is your opportunity to learn about it. You need to have an investment objective. Why do I want to invest? Am I investing for my future? Am I investing because I want to buy a property that, of course, is towards my future? You just need to have an objective. You need to know the objective also entails how you're going to go about it. Risk. You need to have a risk. You need to understand your risk appetite. Am I somebody who is very risk averse? I do not want to lose nothing out of my investments. If I give you 20,000 naira, please just give me my 20,000 naira back. Even if you don't give me any interest, I don't mind. Just give me back. Are you that kind of investor? Are you the kind of investor that will say, let me see, this investment seems okay. There might be a bit of loss. So let me just put a few funds of mine in here and see how it plays out. Or are you the kind of investor that goes all in? I might lose all of my investment, but because this thing promises like a 200% return, let me put everything I have in there. That's a risky investor. You need to understand the kind of investor you are. Rate of return. Understand exactly how much you're getting as your interest, as your return on investment. Understand how that investment works. That helps you plan properly. So with the rate of return, you can have a proper financial plan, right? Diversification is one of the most essential components of investing. With diversification, you can mitigate against several types of risks. So there are different types of asset classes in the market available to you today. So there are different types of asset classes available in the market. You need to understand how to distribute your funds in those different types of asset class. If you like equities, by all means, buy equities, but make sure that you're also playing in the money markets. If you like bonds, make sure you're also buying some dollar-denominated investments. Just spread your risk around such that if equities market is nosediving, your money market will be doing okay. So you have not lost too much, right? If the rates on the bond space are not doing so well, you know that you have your own dollar investments, backing you up, that kind of thing. So that's what diversification really is about. Just basically spreading your risk so that if any risk crystallizes, you are not all in for that particular event. So on that note, I would like to introduce us to a type of investment, very easy to understand, very investor friendly, right? It also encourages a lot of diversification. We call it mutual funds. A lot of people may not have heard about it. Some may have or may have invested in it in the past. And there are also some misconceptions about mutual funds, and I would clear them today and in the next slides. So mutual funds basically collectors and puts them in different types of asset classes. The asset classes range from stocks to money market instruments to bonds, many others. And we also have the dollar-denominated ones as well, right? So the beautiful thing about mutual funds, what I like the most about mutual funds is the diversification in it, right? So diversification one, and you stand to get the highest possible the highest possible return on your investments. I'll give an example. If you have 100,000 naira today and you take it to a bank, a commercial bank, and you say, please, can you put this 100,000 naira in a fixed deposit for me? You can hear offers like, oh yeah, we can give you 2%, right? Because it's what, 100,000 naira. Now, if you take 100 million to that same bank, they'll probably offer them, oh yeah, 8%. So your 100,000 to 100 million, 2% vis-a-vis 8%. What's the difference? Why did they offer different rates? Because of the volume, right? Now, the good thing is if you take that your 100K and put it in a mutual fund, and somebody that has 100 million puts their own fund in the same mutual fund, both of you will earn the same return. So if the return on that mutual fund is doing 10%, you with your 10,000 naira, the other guy with his 1 billion naira will earn the same rate. How fantastic is that? So the reason why mutual fund is thriving is the fact that retail clients are able to earn the highest possible return in the market just by mere investing in mutual funds. Now, let me just, like I said already, the mutual funds industry is thriving. Why is it thriving? Because retail clients are able to invest and gain the highest possible return in the market, something that they would never, ever get from a bank. Now, in 10 years, the mutual funds grew, because year in, year out, investors, especially retail investors, realize that mutual funds is a game changer. I mean, why should I keep my 10K or my 100K in a savings account that is giving me 0 point something percent. Or maybe one day when I even decide I want to do it, I want to put it in a fixed deposit, and then the bank is telling me 2%, even 1% in some cases, it can be that ridiculous. So why would I, put my money when I can earn, so people have migrated from the conventional commercial banking style into the mutual funds industry. And that's why we have seen this growth in the last 10 years. Now, as at September 30th, 2022, they had a net asset value in the mutual funds industry of about 1.5 trillion. Isn't that amazing? And the mutual funds market has grown by 38%. What is the process of mutual funds? Basically, investors, you pool funds together, give it to a fund manager. A fund manager, for example, types of securities, depending on what mutual funds you are buying. If you're buying money markets, Cordros will be buying corporate Eurobonds, the sovereign Eurobonds, just basically diversifying that portfolio. Now, in one investment, with that 100,000, you have been able to participate in different types of investment. You've heard treasury bills, you've heard commercial papers, you've heard fixed deposits. So with just 100K, you've been able to participate in all those types of investments. So that's why you are able to get that high return, because we've pooled funds, we've taken your 100K, taking somebody else's 20K, taking somebody else's. Now that portfolio is as huge as 1 billion. We can now take that 1 billion and put it in different asset classes, and then it yields returns, and then we distribute that return amongst all the unit holders. That's all the investors in that fund. We then distribute the returns to all the investors in that fund. I hope that process is very clear. And please, and so it's not a long tenor, it's not a long tenor type of investment. It's a short tenured investment. So people like it. So people can save towards their rent, for instance, in the money market. People can save towards a trip or some flimsy things. You want to buy something, they save in the money market, and then they can just pull out the funds at any time. That's why people love the money market, right? The risk profile is also very low. Oh, I already mentioned that. Time horizon is short. Investable instruments, you have commercial papers, fixed deposits, treasury bills, right? So let's move to the next type of mutual fund. Call it balanced fund. Balanced fund because it caters to two different types of asset classes. You have the equity side, and then you have the money market side. Now, these are two different asset classes, right? But because we have a lot of clients who don't mind the returns in equities, but they do not want to be 100% exposed to the equities markets, if you know what I mean. So say, for instance, now you buy MTN shares. MTN today maybe is at, this is an hypothesis, I'm not giving you the correct price. Say MTN today is at 267 naira per share. And you buy it today, and then tomorrow it goes to 230 for some reason, not because the company is bad or the stock you purchased is bad. Some clients don't like that kind of risk, right? So because of that, they stay completely away from the equities markets. Now, if they buy it at 267 and it jumps to 300, they love it. In fact, they want it. But the moment they lose a couple, they are dying. Do you understand? So because we know that there are investors like that, so what we do is we create a mutual fund for that portfolio. We buy equities in that. So now we don't just buy MTN, we buy a pool of other stock names. You can buy the banking stocks. We can buy some Okomu oil. We can buy some Seplat oil. Some Seplat petroleum. Just diversify that portfolio pretty much, and then also do some money market, so that if something happens to Okomu oil tomorrow, you are not directly affected You won't go to your portfolio and now be seeing how your money has depleted. The risk is shared amongst everybody in that portfolio. So the risk